Okay, hello to all of you. So I just want to double check here quickly. You should all be able to see my screen now. Debbie, if you, not Debbie, Jenny, if you can just confirm that you can all see my screen.
Hi, Scott. Yes, we can see your screen.
Great. Okay, so welcome to all of you online. It's been a little while since we've done a webinar, so excited to share what's been going on, and a lot of opportunities around the world between Australia, the UK, and America. And tonight we wanted to share with you a deal that I personally have invested in America. I'm also getting a lot of questions at the moment. A lot of South Africans are concerned about their future, and I get a question almost on a daily basis between, what is a plan B? How do you get wealth preservation? How do you become a global citizen? How did you get your son a passport? How do I ensure that fees must fall is not going to continue to really dominate, and ultimately you can send your kid to any university, etc., etc. So what I've done tonight is I've combined the two of them. I want to answer some personal questions around, what I've done, and I've been investing offshore since I was 22 years old, which I wish I could tell you was 5 years, but it's going on 18 years now. And for some of you, it'll be brand new, and for some of you, I can see there's a lot of faces on here that I recognize as well. And you've done it before, and you understand this experience. So let's rock and roll. I would like to say that tonight, if people want to ask questions, please just put it in the little question box, and we'll be able to deal with it. So I can see that Billy's put it in. Let's just see if people actually know where the question box is. So where is everyone coming from tonight? Just type in there. Are you from KZN? Are you coming from Cape Town? Are you coming from Bloemfontein? Have you got over your hangover yet? What about Johannesburg, Pretoria, etc., etc.? So we've got San Diego. That's fascinating. And we've got Cape Town, Geneva, Batu, Gauteng, Durban. Wow. So glad to see Gunter's in the UK. Wow, we've got quite a spread here. I love webinars. You've got people from all over the world. Dubai, Bethlehem. Wow, this is quite. I wasn't quite surprising from so many different places. That's awesome. Okay, so I'm glad that also people know where their comment boxes are. So let's rock and roll. I want to get into it. I want to share with you some personal experiences. So Debbie, just from your perspective, I keep saying Debbie. Jenny, just from your perspective, I'm not going to be watching the questions because it gets in the way of my PowerPoint. So if you can just be monitoring them, and if there's anything urgent, let me know, and I'll check them from back and forth. So this is something that I've been quite vocal about. I kind of get told that I have a bit of a name now, and from a company perspective, we're not allowed to be out there on social media and politics and blah blah. Personally, there's a line that you have to draw. And I drew that line about 2 weeks ago. I'm sick of this fees must fall. I think it's completely ridiculous. And, at the end of the day, I really think the country is lacking severe leadership at the moment. And, I'm tired of not speaking out. I'm a passionate South African. I'm not a negative South African. I still live here. I'm talking to you from a very beautiful nice. As I look out over a sunset, setting over the lagoon. But that also doesn't mean I'd bury my head in the sand, and I'm certainly not prepared to keep quiet about what I think is an absolutely ridiculous situation. So, from my perspective, tonight is as much about providing solutions to this. I also want to explain to you why this doesn't concern me. And even though my son is 4.5 and growing up in South Africa, I think it's a major gift for my son. But I certainly won't be beholden. I went to UCT. I think it's a great university. I also did my master's in London. By the way, I put myself through both those courses. My father went bankrupt when I was 17. And so, people mustn't tell me they need freebies and handouts. It's absolute rubbish, and they will remain in the poverty cycle. But we didn't come here tonight to discuss that. We came here tonight to discuss what we can offer you and what we've helped hundreds, if not thousands, of South Africans already achieve. And that's really peace of mind, wealth preservation, a plan B, and the one that is probably very close to my heart, and that's freedom. And, for me, it's freedom of where you want to live. It's freedom of where you want to send your kids to school, where you want to send them to university, who you want to donate your money to. And ultimately, it's the freedom to make choices you want for you and your family. So, Henny Besaidnout, my business partner, said to me, and a number of us when we were on his farm about 18 months ago, he said that we have to do what we're doing so that we can help South Africans live in South Africa because they choose to, not because they have to. I think it's quite, endearing that Henny and myself and a number of my colleagues all live in South Africa because we choose to, not because we have to. And we want to share with you tonight how you too can have that. So just a little bit for a lot of new faces online, and I'll keep it short for those who already know me. A little bit of background, and if you want to know more, it's all in my book, Property Going Global, which was endorsed by Clem Santa. It was published about 2 years ago. I must admit, I do need to update it when I find some time. The intention is to bring out version 2. But my point being is my entire story is in here. So if you want a copy of the ebook, just type in there PGG or Property Going Global, and we'll send it to you. In simple terms, the story of two brothers that really, defined my life. The first one was my father. He wanted to be a farmer in Zimbabwe. And in '76, we were run off our farms. We got 3 farms in Zimbabwe. We were literally run off by the freedom fighters or terrorists, whatever you want to call them. They were killing everyone. And I was due to be born in 6 weeks. My parents packed whatever they could into a car, and they drove to Durban. And my life, my father lived a life of reaction. He put my brother and I through very good schools. He gave us self-belief. He was a wonderful dad. But unfortunately for him, he never got to live the life he wanted to do. And, he took a corporate job. He was financial director of one of the listed companies in South Africa. And then he always wanted to go on his own, and he went on his own at the age of 49. I was 17, and he went bankrupt. And unfortunately passed away about 10 years ago. And really, from my perspective, it was a very much an example of someone who doesn't plan for the future. In comparison, I had my uncle who in 1980, opened his first offshore bank account. He didn't leave Zimbabwe. He decided there was great opportunity there. He opened his first offshore bank account in 1980. And 23 years later, he decided that it was no longer good for his family to live in Zimbabwe. So he immigrated to Brisbane. Now, at the age of 53, he bought his way into Australia, and a lot of people don't know this. It's very difficult to get into Australia after you're 45 unless you're a global citizen and you have money. And he bought his way into Australia, and I can teach people how to do that. I've helped a lot of people, and we've got the right partners to be able to do that. He bought himself a house for cash. In 2003, it was 1.8 million Australian dollars, which is a hell of a lot of money then, and it's a hell of a lot more money now. And my point being is that because he opened that offshore bank account and made money in Zim, but 23 years earlier, put money overseas and invest in first world assets with a first world income, it enabled him to buy his house. He sent his kid to one of the best schools in Australia. Subsequently, his kid was offered bursaries and acceptance to some of the best universities in the world. And the one that I love most is that he never had to work for an Australian. I've seen a lot of people, work their whole lives through their 20s, 30s, 40s, and even into their 50s, and then immigrate and go from being. I had one gentleman turn to me personally and tell me that he used to be a general and now he's a foot soldier, and I certainly don't want that for myself or anyone that's close to me. And so that's why this stuff is very important to me. And I always say everything in life is about strategy. What is your next move? You can kind of have blinkers on and not really focus on what's happening both locally and globally. And or you can really aim to be a global citizen. You can learn from people that are doing it. You can copy what people are doing. Tony Robbins says the fastest way to be successful is copy what successful people are already doing. If you want to be wealthy, copy what wealthy people are doing. And it's no coincidence that the wealthiest people in South Africa are investing in first world countries, and they're also investing in direct real estate that pays them a passive income, because it ultimately allows them to ride the huge uncertainty which we face from a global economic perspective. And so just to give you a little bit of research, if you know me well, I'm all into my research. I don't make decisions based on gut feel, and I certainly don't use hearsay. And so what I was interested in a couple of months ago, about 3 months ago, was if I took the exact same amount of money, and I go back as far as records could go back, which is 1978, and I invested that same amount of money in South Africa and or America, where would I be today? And taking into account, it's effectively 38 years, you would see that the red line is South African investment based on long-term South African averages, and the bluey purple line is the American average. It's about a 424% difference, so you'd be 4 times better off as a global citizen if you invested in America. One thing I would like to point out is that we started helping people invest in the third quarter of 2012, which was pretty much the dip of the market in America, and I don't think our timing has been too bad in terms of calling the market. Now, you might call it a fluke, but let me show you some other stuff today. Okay, Australia. If you did exactly the same thing in Australia, the blue line is South Africa, the red line is Australia, you'd be 499% better off, so nearly 5 times better off, which I think is also quite important. I would also like to point out that we started helping people invest over here in Australia. We actually stopped around 2013 because the returns weren't that good. You know, Henny, as an example, started with $4 million. He turned it into $44 million in 4.5 years. That company is now listed and it was worth over $600 million. We got out of the Australian market for about 2 years, A, because the American market was so hot, and B, because there was a rising interest rate cycle. And we got back into it about 18 months ago. And you can see it's all about riding the cycles. And again, it's not gut feel. I'll explain to you later how we do that. And then lastly, on the UK, again, what's the difference of investing in the UK? Well, you'd be 332% better off, or roughly 3 times better off, if you invest in the UK. And what's also interesting here is that I started investing in the UK over here in 2002. I rode the market. I invested in a number of properties through to about 2007, late 2007, where I stopped. I believe there was too much risk based on the income returns that the assets were producing. We got back into the market, ironically, in 2009, so around this period here. This was a beautiful buying period. We were buying properties at 40p on the pound. And ironically, we actually stopped quite quickly. We stopped in 2010 because we believed that the risk was still at the same level it was pre-crash, and yet not a lot had changed. Some would argue that we've missed the market. I don't agree with that. I think the market is grossly overpriced. The income returns are now traveling at like 2%. And so you could say from a capital growth perspective, we've missed the market. But from a real returns perspective, I don't believe we've missed the market. I do believe there's going to be a correction. It's already happening. You can watch my YouTube video 18 months ago where I told you there was a crash coming. It's going to happen. It's guaranteed, based on supply and demand, interest rate corrections. And, again, for me as a global investor, if I was an estate agent trying to sell you a house in London, I'd give you 1,000 reasons why you must invest in London. But as a global investor, I'm not caught up in emotion. I just look at the numbers, the research, and the trends, and we invest in the right place at the right time. And I don't see the point of investing in markets where you're getting low returns when you can invest in other markets where you can get 3 times the return. And it's not a gut feel, hope and pray strategy based on capital appreciation. So if you had a crystal ball and you can go back to 1978, I'm sure you would like to know these trends. If you invested the same amount of money, in South Africa versus diversifying across America, Australia, and the UK, this is where you would look in terms of your net asset value. Now, I didn't know this back in 1978. I was only born in 1977, but maybe with my Zimbabwean half heritage, my other half heritage is South African, it's just innately in my blood not to invest all my money in one country, one asset class, or one currency. And I've been investing in England, Australia, and America in terms of creating a diversified portfolio now for many, many years. As I said to you, I started nearly 18 years ago. A lot of people say that investing is super complicated. They sit there and tell you, all these algorithms and facts and how clever they are. I truly believe that the more people overcomplicate things, the less they actually know about the topic. I believe that investing is actually really common sense. And, if there's too many properties coming into the market, like there are in London, and interest rates are going to go up, it's only a matter of time until the property prices fall, because investors will pull out of the market, especially the foreign investors who are primarily the investors, versus investing in old age, healthcare, medical facilities in the first world like America, England, Australia is an absolute no-brainer, because the baby boomers are getting older. They need more medical care. There's more money and investment going into that sector, and therefore, it's a great sector to be investing in. So I don't think you need a PhD in investing. I don't think you need a PhD in economics. I actually think that it's fairly common sense, and you need to trust your gut and not let middlemen get caught in the middle and dilute your returns with a bunch of fees. Just to give you a couple of highlights, I did my first project when I was 13, my first real estate project. Everyone thinks it's ridiculous. It's not. I persuaded my parents. That was my bedroom there with my brother. We shared, and I got them to agree. I showed them how I would do it and help project manage it. Now, don't get me wrong, my folks gave me a hell of a lot of self-confidence. I guarantee you there were architects and quantity surveyors and everything else, but my memory is that I did it. At 22, we did our first development in Cape Town from London. We were living in London. We bought a house and we developed it into 6 townhouses in Rondebosch. At 24, we bought our first house in London. I always talk about us. You might notice I've never bought a property on my own. I fully believe in partnership and working with people. We bought this house in Wimbledon back then for £270,000. My biggest mistake was not buying every property on the screen. 5-minute walk from Wimbledon. one of the best rental markets. And, as an example, our core tenants are Antipodeans, and they love a bit of space in London, 5 minutes walk from Wimbledon Station. From there, we had so many people asking us about how to do it that I started a company called IPS to help people invest in South Africa, so expats from London into South Africa. And then it became South Africans into London, and then Australia, and then America. So we've helped, thousands of South Africans, well, foreigners invest into South Africa, or expats, foreigners or expats. Hundreds invest into London. We've helped hundreds invest into Australia, and in more recent years, hundreds into America. You might notice a lot of residential. In 2009, I met Henny Besaidnout, who really, has the grey hairs and the experience, and enabled us to go heavily into commercial and to really find institutional grade assets. And we started investing in commercial assets through the Wealth Migrate platform in terms of where we were. I've mentioned the book. So I did all my modeling based on Clem Sunter's scenario planning. I shared it with him. He was so impressed that he told me he would endorse it and that I needed to write a book. So I've run 3 comrades. I'd run them back to back rather than write another book, which is probably why version 2 is well late. But anyway, if you want to know everything I'm going to share tonight, it's in much more detail in the book. And then lastly, what I get really excited about is that I wrote a dissertation in 1998 on technology and how it was going to change our lives and how it was going to change the property industry. Now, back in 1998, that was pretty much ahead of my time. But there's 3 things that have happened from a technology perspective that is really important. Firstly, the internet has completely transformed how we actually do business. If you look at Airbnb or Uber, I think that's self-explanatory. There's been a significant adoption of technology. We moved away from emails and we've gone, to online dating, and then ultimately to e-commerce and social media. And now we've basically got social commerce, or what most of you will understand as online investing. And then there's also in the last 3 years been significant regulatory change, which has allowed this to happen. And, to ensure that one is compliant and with all the different regulatory bodies around the world. Why is it so important? Well, the old system is broken. You've got an investor, they want to invest in a property. There's actually 16 different middlemen between you and your investment. It's grossly diluted by fees, and that's why no one ever makes any money except for the person actually running the fund or REIT. And that's why people don't trust the system. There's no transparency, and there's huge fees all the way through the process. The other thing that's really important is that most people don't understand the value chain of real estate. Now, if you don't understand the value chain of everything, you're never going to be able to make money because you don't know how to go up the value chain. So in real estate, it starts with land zoning. I don't have time to go into this in a huge amount of detail, but if you want to, go and read my LinkedIn article where I wrote all about this. And maybe, Jenny, if you can go to my LinkedIn profile and just find that article and post in the chat box, I'd appreciate it. The next one is the developer. After the developer becomes the investor, so you've got a horizontal piece of land where they get zoning. Then they build a vertical structure, which is where the developer creates value. Then you've got the investor, which is where they put a tenant in and create an income, and they become an investor. Often it's the same person, developer, investor. The way everyone makes money in real estate, I'm yet to find a way where someone made a significant amount of money that isn't through this. They ultimately, they get the rent roll, they basically blend the rent and can prove the long-term rentals, and then they sell it on to a REIT or a fund who's looking to acquire cash flow, and they make a significant return. And then you or I come along and we invest in that REIT or fund, and we can't understand why we battle to beat inflation, let alone get wealthy. And so just in terms of the returns, a land investor takes a lot of risk. It takes a long time. They'd be looking for an IRR 30% plus generally. A developer is generally looking for 25% plus IRR. An investor is generally looking for 20% plus. A fund or a REIT is actually only looking for cash flow, and quite often, forget about share price value. That's irrelevant. It's got nothing to do with it. It's based on the net asset value and the accumulated value on balance sheet of the portfolio, and most importantly, the income cash-on-cash return of the assets. And generally, they're buying at it's called a cap rate. They're generally buying at a cap rate of 5 to 8%, and often quite a lot lower, depending on the surety of the income. And then we come along and we invest, and we wonder why we battle to beat inflation and why less than 1% of people at the age of 65 in the Western world can actually retire wealthy. So if anyone disagrees with me, this is the article I was talking about. I highly recommend that you go and read it. It's actually talking about Robosis, which is a fund here in South Africa. They're buying from a developer, which is called the Billion Group, and they're talking about how they're buying a bunch of shopping centers, how they basically haven't stabilized the rent, and how they're overpaying for the assets. Now, who do you think is buying into those overpaid assets? And more importantly, who do you think is making all the money? the Billion Group is, who's the developer. Rebosis is owned by the same person. And so they've just made a couple of billion rand by doing the deal. And it pretty much sums up exactly what I'm talking about in terms of the value chain. Now, the question a lot of people have is, how do they invest? Where do they invest? Why do they invest? What is the timing? I spoke a little bit about getting the timing right. We're not perfect, but I think we've got a fairly, successful track record based on market cycles. And there's a reason for it. We've got a process called GIDS, our Global Investment Diligence System. It's made up of a 10-layer system. It helps us know, based on currency, where to invest, macro country, which country to invest in, financial structuring, country, how do you find the right partners, which cities do you invest in, how do you optimize the investment of the specific deal, full-on 143-point due diligence section, the management, ultimately our wealth assist solution, and finally our customer experience ongoing. And it's this system which was built out through over 30 years worth of experience between, Henny, myself, Dr. Dolph de Roos, and Michiel, and many others, that has evolved together, and now we're building into our systems based on algorithms so that everyone can be part of it and basically invest like institutions with institutional type research and institutional type data. So if you come back to the value chain, I always ask people, if you know that most of the money is made in the development sector and the investor sector, or even if you're prepared to take a bit more risk in the land zone sector, why don't you do that? And the often answer is like, don't have the money, don't have the knowledge, don't get access to the deals. And so, that's why I invest in a fund or a REIT, because they have the money, they have the liquidity, and I rely on them to go and make investments. Well, now that technology's arrived, you can, just in the same way you don't need to deal with a call center operator to book your taxi, you can just book a taxi through using technology on Uber. Well, it's exactly the same thing. Technology now enables you to invest with the developer if you want to be involved in the development cycle, and we call that our growth plan, or you can invest with at the investor level, which we call our income plan. And in simple terms, our growth plan tends to be a 2-year investment. It's obviously a development. It has higher risk with the return based on selling the property after the 2 years. Whereas an income property is an existing asset. It has an existing rent roll. We look to add value to that asset, and it pays quarterly dividends. So you get consistent cash flow that you can plan for. And so just to give you an example, this is Cyprus. It's a multifamily in America. It's one of the examples of an income-producing asset. And this is something that I personally have invested in, and I will explain a little bit later why I've done that. A lot of people ask me about becoming a global citizen. This is my son. He got his British passport a week or two ago. I'm also getting him an Irish passport. Now, with all due respect, I don't have to necessarily go and buy a passport. You need to be very careful. Chapter 10 of this book, I've looked at 16 different markets: Cyprus, Malta, Mauritius. You need to be very, very careful of what you're getting when you invest. Portugal even, as to buying a good asset. I'm not going to talk a lot about that tonight, although I will share how to get into America, because we've got a very good partner on the ground that can help you get an EB-5, which is ultimately get a green card and citizenship for you and your family in America. My big belief with my son, it's far more important to make him a global citizen. It's far more important to educate him about the world. It's far more important to teach him self-belief, and then also to have first world assets and first world income to enable him to be able to travel the world, and if he wants to study at a university anywhere in the world, to be able to make that happen. So I had a conversation with my brother about 2 weeks ago, I think, and I said, look, as much as I loved UCT, one of the happiest years, 4 years of my life, I don't think it's going to be happening for my son, because he's putting up with this rubbish that's happening in South Africa right now, and particularly how they're dumbing it down. And so I went and looked, what does it cost to go to the average university in the US, the UK, and Australia, and then I also went and looked at the top: Harvard, Oxford, and Melbourne University. And I've done the maths for everyone. You don't have to go and do it. So you can see there that you've got a tuition cost, you've got a total cost, so that's including flights, accommodation, and spending money. Just by the way, your tuition cost, and then your costs above that, it's a 1.8 on average, a 1.8 increase. Not my numbers, based on all the research I did. So there you've effectively got an annual cost, and then you've got a total after 4 years. You've got an exchange rate, so you need to be able to convert it all back to US dollars, and ultimately it gives you a total amount of money that you would need over a 4-year period. Now, I want to be very clear here. I doubt that I'm going to be giving my son money to go to university. just like myself. I see no reason why he can't do it himself and put himself through university. But what my father did do is give me the self-belief that I can do it, and told me to go out there and apply for London University, and I got in and did my master's. But my point is, my father had the self-belief. So if I've got that money in the bank, I'm certainly going to have the self-belief to come up with a solution for my son. So I then looked at a couple of options. If I pay $100 per month for 10 years, $500 per month for 10 years, $1,000 for 10 years, and then $1,000 for 14 years. The reason 14 years is John D's 4.5. So that means that he'd be going to university in 13, 14 years' time. And I looked at three different options here. 6% is the average South African property. So the 30-year average for South African properties returns is 12%. If you take also the 30-year average for the rand devaluation, it's 6% year on year against the US dollar. If you want to, you can kid yourself, bury your head in the sand, or you can be a global citizen. You therefore need to look at the real returns, which are closer to 6%. If you take an option like a Cyprus, which is an income-producing asset, the internal rate of return, I had it 15. Ironically, when you're going to see it later, it's actually quite a lot higher. But let's be conservative and say it's 15%. And then if you take a growth project like the one in Kensington, which is the residential development opportunity in Australia, you're looking closer to 20%. And what I found really interesting is that, if you take those returns annually over this period, you can ultimately see how much capital you will have. So in simple terms, if you look at it, and I bring back the total amount of money you need, you can see the average Australia, average US, average UK, Melbourne, Harvard, and Oxford. You can see that if you invest $100 per month for 10 years, it doesn't matter what you do, it's not enough money to be able to send your kids. So you can maybe send them to year one of an average Australian, average US, and average UK, but they'd have to make peace after that themselves. If you invested £500 per month, dollars, you would, South Africa, there's nothing you can do. $98,000, you're starting to get somewhere here, and then from 19, this income producing asset, you can send your kid to the average universities. And once you look at $1,000 per month over 10 years, you pretty much can send them to any one of the average universities. And if you're looking over a 14-year period, you can actually see here that if you're investing in an income-producing asset, like Cyprus and/or Kensington, you can actually invest, and they can go to the best universities. And if you're getting a return close on 20%, you can actually send 2 kids for cash. So this is relevant for me because my wife and I have committed to, around $10,000 per project, which is probably quite a lot more than $1,000 per month. But anyway, I wanted to keep it simple for people to be able to analyze. And so that really kind of gives you a little bit of context. I specifically wanted to keep that within the half-an-hour framework. And, I bring up this nice little graphic. And before I go any further, I want to see if there's any questions. Because the question really is, what do you do next? I've explained to you what you do and why you do it. But I want to now go into the how you do it in terms of the American opportunity and what we're doing in America, where we're investing, why Texas, and what we're investing, why I'm investing myself. Is there any questions that you want me to answer just in terms of the overall framework so that you understand where I come from, where Wealth Migrate comes from, and most importantly, why we do what we do? So I can see that Brett wants a copy of Property Going Global. So if you want that, just type in there PGG or Property Going Global. And Mans has said, yes, sorted. Which is better to invest, USA or Australia at this time? Great question. Rion, it's nowhere as easy as that. It depends on your personal needs. There's pros and cons to both markets. And, again, I would suggest you chat to an investment consultant in terms of your needs, because every opportunity is relevant, but one needs to basically, be able to make decisions. And that's why I don't make decisions based on gut feel. I also don't give financial advice. I'm not a financial advisor. I only tell you what I'm doing, what I've done, and I can share with you. So there's different pros and cons. If you're looking to move to Australia, there's 4 significant benefits to investing in Australian property that have nothing to do with property, which can help you immigrate there. If you're looking to move to America, there's significant upside as well, but it really depends on what you're looking for. Okay, so you can see I've put up our first poll. I want to get you guys engaged and see how you're getting involved. If I'm going to share lots of information tonight, then I also want to understand who I'm talking to and really what you're looking for. Because if we don't understand what you're looking for, then we've got no idea and we can't add any value to you. Our time is precious, as yours is. the more we understand what you're looking for, the more we can actually help you get it, basically. Is it possible to help get a British passport? It depends. So again, it depends on your personal background. And what I would say, honestly, is that people need to focus less on getting a specific passport and more on becoming a global citizen. Take my uncle's example. He had nothing but a South African passport and a Rhodesian passport. Sorry, Zimbabwean. Bit of a slip of the tongue there. And, he bought his way into Australia. It's much more important to become a global citizen because that'll give you the freedom to choose rather than whatever you can get. Okay, so I can see over 50% of people have done the poll. I'll give you another 5 seconds. I'm going to close the poll, and then we're going to rock and roll into what's happening in America and specifically why Texas. Anyone else want to vote? Going, gone. Okay, so let's close out the questions here. And anything from your side, Jenny, anything you need to make me aware of before I share what's happening in America and why we're investing in Texas, and more importantly, why am I investing in specific deals?
Hi, Scott. We've just got a couple of questions from Romualdo and Rion that you might want to have a look at.
Okay, so Meroldo, I'm not quite sure how to pronounce that. What are the tax implications for the different types of nationalities? So great question. We paid a lot of money to Grant Thornton right up front when we set up all our structures to ensure that they are tax efficient. So that question could be asked two different ways. The one thing is, what is the tax implications if you invest in the country? And the other one is if you, from X country, how does it impact you? So I could argue, I could answer that both ways. Most importantly, Romualdo, is we spent a lot of money, like I said, to make sure it's as tax efficient as possible. And then Rion said, just an investment staying in South Africa, what will you choose? Just as an investment staying in South Africa, what will you choose? Again, I would blend, Rion. So I'm not sure if I'm pronouncing that right, but I would do both. I mean, I can only put my money where my mouth is. In the last month, I've invested in Australia and in America. I've invested in a growth project and I've invested in an income project because I like to have a diversified, balanced portfolio across countries, across residential and commercial. Okay, I'm gonna rock and roll. I'll come back to those questions a little bit later. Hopefully, you've enjoyed our little screen with where in the world do you actually invest. So let's look at what's going on here. I think market research is one of the things that differentiates us dramatically. A lot of salesmen out there will tell you where to invest and why to invest. I'll give you all the research proving to you that London's the place to invest right now. And yet they tend to find the research that suits their needs. If you've met someone that's invested already on 4 different continents, I'm sure you can understand that we're not partisan, and we certainly don't have any what's the word called? We're not pushed in any one direction. The research, we put it into our systems, and the research tells us what to do and where to do. So let's look at some of the research that I think is relevant. We look, and Henny learned about this at least 4 or 5 years ago, about aeroports. So in the old days, it was all about ports and ships. Now it's about aeroports, all commerce, tourism, and basically sustainability of a country now takes place around airports. And so what's really interesting, if you look here at Georgia, that's Atlanta. Texas is number 4, just in terms of areas. So there's a couple of things that overlay here as to where we invest. We also invested in Florida, by the way, in terms of just some of the areas, in terms of the biggest airports and why we invest in those areas. So you can see there. Then the second thing is there's top landlord-friendly states. So there's over 50 states in America. America is a very big place. Everyone runs off and wants to invest in California or New York. Little do they know that the tenant laws are not too dissimilar to South Africa. It's virtually impossible to get rid of a tenant. There's huge rates in taxes, and so your gross return might look attractive, but your net return is not that great. I personally stopped investing in South Africa in 2010 because I was sick and tired of the tenants having all their rights, and I started investing in first world markets where I, as the landowner, the person who owns the asset, actually having the rights. So we focus on states that are pro-tenant, and what I think you'll find quite interesting is, again, number 1 is Texas. Arizona, Dolph talks a lot about Phoenix and the opportunities there. We've got Florida, number 7. We've got Georgia, number 8. And we've also got Tennessee and Oklahoma. So we've invested in Texas. We haven't invested in Arizona. We haven't found a partner we can trust on the ground there yet. We've invested in Florida. we've invested in Georgia, we've invested in Tennessee, and we've invested in Oklahoma. So it's quite interesting. If you look at the top 11, we've invested in at least 5 of them. And then in terms of the highest growth rankings, based on Forbes, you can see there that Texas is number 1. North Carolina has come up a number of times on our radar, and again, it's about finding the right type of partners. You can see here some of the growth areas. California is the numbers talk well, but there's other stats that I've already told you about. Arizona, again, Dolph talks about that. Florida, Oklahoma, Tennessee, Georgia. So once again, we're in all the different markets where we're getting the best growth. Texas is the best market to invest, according to Forbes. So this came out towards the end of last year. And what's really interesting is understanding the Texaplex. So there's a great video about the Texaplex. And again, Jenny, I'm not sure if you've got it available. If you could just Google Texaplex and put it in the chat box for everybody. It talks about the huge growth that's happening in Texas. So it's basically from a city called San Antonio. You've got Houston in the bottom right. You've got Dallas and Fort Worth that are effectively coming together. And then you've got Austin, which is up the top here. It basically forms a nice big triangle. Oh, I lied. There's Austin. Okay, sorry. Well, anyway, you've got your triangle. And this is known as the Texaplex. And there's massive investment coming into Texas. There's all the big medical companies are moving there because they put a moratorium on insurance liabilities at $1 million. So all the big medical companies moved there. They've also, it's a very tax-friendly state, so a lot of the head offices have moved there. There's much better affordability for people, and good job growth. So there's huge momentum of people moving into the area, and that's why cities like Fort Worth and Dallas are literally merging together, like Joburg and Pretoria. Houston has, experienced tremendous growth in terms of what's happening, and that's also not just oil-based. Less than 40% of Houston is actually based on oil. And then Austin is becoming the new Silicon Valley in terms of what's happening. So I could talk all night about the research. I'd recommend you go and watch the Texaplex video to understand what's happening in Texas. And taking that all into account from a rankings perspective, this then looked at where we invest and why we invest and how we overlay them, for our investments. So you can see there that Michiel actually put this together, and Billy, taking all the stuff we spoke about: landlord, medical research, Forbes growth, most traveled. And you can see there that the areas that we're focusing on are Texas. You can see you've got Atlanta and Georgia. You've got Tennessee just up here. Memphis is on the border just here. You've got Florida. We're doing the EB5s and stuff, and we did quite a lot in Florida before. So I think it gives you a good idea of some of the markets that we're focusing on and why we're focusing there. Which segments do you invest in? Well, what's fascinating is that when Brendan Brown and myself and Neil Peterson from Real Estate Investor Magazine, I went there in 2010 on my own. I spent 5 weeks with my wife, traveling all around. We knew there was blood on the streets. We knew there was opportunity, but we couldn't find partners that we could trust. We were lucky because we were probably a little bit early. The market did continue to subside for another 2 years. The bottom of the market was April 2012, and we got going in August of 2012. So I think we did pretty well on the timing. And one of the things we wanted to invest in was multifamily. So one of the reasons we stopped investing in Florida was that if you buy an apartment, as South Africans would call it, they call it a condo, then you basically have what we call your sectional title fees. They call their HOA fees. And although the gross yield would be 12%, the net yield could often be as low as 6%, because in the times where they had the crash, the HOA fees stayed the same. The value of the property came down dramatically, and therefore, it obviously impacted the percentage net return. So we wanted to go after multifamily, which is where you can buy the entire block, and then you can control the HOA fees, and ultimately you can manage the whole asset. Back in 2012, this became a very hot asset with the institutional investors because, and I'm going to explain to you why, traditionally, obviously, it was seen as residential, but it started being seen as a commercial asset because of the stability of the income streams. And with the crash, a lot of people lost houses. And what did they do? They moved out of houses, they moved into apartments. So this became a very hot institutional investment, and it was very, very hotly traded. And we noticed cap rates diminished dramatically from, the high 8s, 9%, which is where we started, down to the 5%, and it didn't make sense. And so we've been looking at multifamily aggressively now for more than 3 years and actually trying to find the right partner who could get access to the right type of deal flow to enable us to get into this market. And like I said, it's similar. It's got a single title. You own the entire block or the entire apartment complex. And then you've got single management, so you can control the costs. You're no longer paying a 10% management charge. You can, you employ someone on site. I've done the same thing in London, and it works very, very effectively. And like it says here, if you've got more than 4 residential units, it's deemed a commercial real estate asset. And what's interesting is you can get commercial financing. Most of you online will know some of the challenges we've had around residential financing, either for apartments or single-family homes. And the great thing is you've got hundreds of income streams, and so there's very low risk no matter what happens in the economic environment. If you look at cap rates, you can see here some of the research of the different cap rates. You've got regional mall, big box, grocers, drugstores, office, industrial, and you can see the cap rates here. The minimum, you can see the average, so 6, 6, 5, 6, 7, 6, 7, 5. The max, 9, 8, 9, 10. So you can see kind of the range, and then you can see kind of the average in terms of where they're at in the last 12 months. One of the things we like about cap rates and multifamily is that you can actually see here that the cap rates have dropped. Remember I said to you, they became, look at what you were buying at. You were buying at cap rates north of 8%, which I've already told you. And then what actually happened was that as they became very, very popular with the institutionals, the cap rates started to drop quite dramatically. And what's interesting is that you can see the average cap rates on apartments are now traveling at 5.6, 5.3, 5.2, even 4.7. And that's the reason we haven't been able to invest in them, because from an investment perspective, the numbers didn't make sense, and there were better assets that we could buy from a cash flow perspective. That's you can also see here in terms of just the decline of home ownership. So again, why multifamily has become so popular. Particularly, you can see what's happening with the millennials and even the 35 to 40-year-olds. They got hit really hard with the crash. They didn't have equity in their properties, and a lot of them got foreclosed upon. In my experience, 8 to 9 out of 10 Americans I met had lost either their home or an investment property. And so you can see here how they've been impacted. And this is a trend that is going to continue. The bottom line is the youngsters want more mobility. It's less about owning a home and more about, it's this whole sharing economy. And, it's the lock up and go. They like the apartment. They like also being able to live with other people. It's really, really becoming more and more attractive as a long-term trend. You can see here what's happening with the population. So also just with the population growing in terms of the different age groups. And then also the home ownership rates are down. So you can see what's happening here, and then the long-term averages. So all of this bodes very well, because if you understand the cycles in America, you start in a trailer park. If you're the poorest of the poor, then the next affordable thing is apartments. Hello, boy. Hello, come sit down. And then if you make money and you can buy something, you tend to buy a condo, which is what we would call a sectional title apartment. Say hello to everyone. Hello. I'm just teaching everyone how we can make you a global citizen. Hey? Are you saying good night? Good night. Good night, boy. Love you. I'll see you now. Okay. Okay, so and then from a condo they go out and they buy a single family home. And so it's really important to understand the cycle, because if people are moving away from home ownership, then the obvious focus is then these apartments. Employment trends, you can see what's happening. So the American economy has really rebounded well since since we started investing in 2012. We've noticed a marked difference. And then you can also see the service sector jobs increasing, and that's why places like Texas are far more appealing to us, because of all the service sector jobs versus something like Detroit that's all based on motor cars that are going bankrupt. And then lastly, you can see here with regards to the yields and the average rents. And again, we like to be in a sector. We don't like to buy the expensive properties. We like to be in the mid-market where the moms and pops, mom and a dad and 2 kids, and then the millennials below that from an affordability perspective. We find it much more robust, much more sustainable. Okay, so let's rock and roll. Now, we've been obviously looking at multifamily for a long time. Henny, Michiel, and myself, and Jaco Maritz. have been scouring the markets with guys like Ricky and the teams, Jason, to really find good deals and find a partner we could trust. And finally, after nearly 4 years of investing in America, we finally came across a partner. I'll tell you a little bit more about the PPA group just now, but a phenomenal partner. And because of their track record, they get access to deals that others wouldn't. So this particular deal, there were over 20 different offers. We were not the cheapest offer, and we weren't the most expensive offer. And yet we won the offer because of their track record in the market. They're an Inc. 500 company, the PPA group, and they're one of the most respected in the space, not only in Texas, but in America in the multifamily. So we got access to this opportunity. It's a multifamily apartment. It's located in Houston. The purchase price is well below the replacement cost, which for us is a very good indicator when it comes to value. There's a growing population. I explained that, and there's a new corridor which I'll show you now on the map. It's a Class B, so again, not right at the top. We like to be in the affordable market. You can see there the total rental space of 18,000 square meters, 252 units. So the best way to understand this is like buying a block with 252 tenants. The location is Houston, and you can see there the purchase price is $15.7 million. The equity was just short of $6 million. The investment income, quarterly distribution, so that's the cash on cash, is 7.4%. The investment return, our internal rate of return, is 19.6%, so just short of 20%. Remember, if you take those three university scenarios, the one at roughly 20%, the investment period is 4 years, and the minimum investment is $10,000. So we have beta tested $100 internally. We've had over 100 people. It is where we want to go, but at the moment our minimums are still $10,000 for people to invest into projects like this. And this is a live offering. We've secured this deal. We've actually closed on this deal in terms of the deal. And again, because of our very good relationship, we were able to structure the deal. So this is a guaranteed going ahead. I've already invested in this deal, and it's, you know, we know what's happening, and now we're allowing other investors to participate. So this is a great deal because we secured it. We know what the numbers are, and we're allowing people to participate. In terms of the location, Michiel's actually taken me up here. So you can see you've got Houston, you've got the inner ring road, you've got the outer ring road. And ExxonMobil have built out a campus here in the Woodlands. It's unbelievable. Take Melrose Arch and times it by 100. Take Century City and times it by 50. And you'll get some sort of idea of scale of what they're doing in terms of ExxonMobil. There's a huge corridor up here. You can see Houston Northwest University, the whole medical center and precinct. And we're based right here. You've got the airport there. So again, very, very good from a location perspective. And one thing that's really important is transport. It's literally 5 minutes off this major highway, which goes directly into the city. Remember, most people that live in your type of tenants won't be trying to commute all the way into the CBD. It doesn't work like that. There'll be jobs all in these outlying areas, as an example, at the airport or ExxonMobil, etc. Key points: the multifamily capitalization rates are not expected to be impacted by interest rate hikes in the short term, so that's very, very important. So we're always looking at risk. How do you manage risk? What happens if interest rates go up? How do we manage our assets? Very stable multi-tenanted income. My understanding is that it's got 92% occupancy, so something we like. Again, we know that when we can pay the mortgage, we've already got the bank financing from Fannie Mae, second biggest bank in America, and at very attractive terms. I think it's around, I don't know if Michiel's here, but it's around 3.94%. So very, very attractive terms, which on a cost of capital, which allows us to be able to pay the cash on cash returns. The location, I think I've explained. The state is obvious, landlord-friendly state. And our strategy here is a value add. So we like to buy assets where we can add value. We don't like to just ride the market and hope and pray. So less than half of the units have actually been converted. The previous owner ran out of money. And so we will be renovating them internally, which will allow us to increase our rent roll, which will immediately increase the value of the property, even if the cap rates don't change. And then the cap rates, our expectation is the cap rates will compress further, which will allow us to create value. And from a sale perspective, and there's always the option to actually condo it off and sell them individually, or even sell off half and keep the asset like Henny did in Australia. And then the only thing that's important here is that people can only invest through the platform. So if you have an LLC already, we can't go through the LLC. The lender's requirements of for Fannie Mae, if there was a change of ownership, then they would charge a 1% fee. So on $10 million, 1% is over $100,000, which is ridiculous. So we did it through our listed regulated exchange environment, which is where we got one cell, and then it allows people to invest with a minimum of $10,000 into that cell, and there's no change of ownership in terms of Fannie Mae Fannie Mae. Sorry. So it's just why we can't do LLC. So if you've got an LLC, I suggest you invest through the platform. By the way, anyone that's got an LLC, Kevin Allen, one of our most intelligent guys in the team, is putting together a whole project hassle-free. You should really watch your space if you're a current investor, because we're going to be giving you options in the next couple of days. I actually think it's going out tomorrow. Options where you can reverse all your residential and commercial assets onto the platform and run the entire thing through the platform versus having to have LLCs, accountants, ongoing fees, etc. Let's make life easy. That's what I would like. Okay. Investor cash on cash is 7.4%. 19.6% internal rate of return. I've said that. I've given you the exit strategy. I've spoken about the value add opportunity. And I think also, Jenny, if you can just put in the video there, it's the flying over video. I've been there personally. I've been on the ground. I've met the management agent, very, very impressive lady, and what she's doing to increase the rent roll, which again is adding value. And I also took my quadcopter there, and we did a flyover, and you can get an idea of the market. There's a really upmarket development right next door, which is always a very good sign. And you can see there in terms of the cap rate, so we're buying at a cap rate of 7.57%. So if you remember, the average cap rates are lower than 6%. So one of our modeling is that we buy it at 7.57, and we would exit it at 6 or below, which will give a capital growth increase of anywhere from 25 to 30%, which is one of the things we're looking at. So you can see there the 6%. The equity raising period, so Michiel and I were actually there in the middle of September. We did the final due diligence, signed off on the deal. The deal closed about a month later, and we're in the final stages of raising equity. If you are interested in this deal, it's very seldom we get multifamily deals, although, to be fair, PPA have now managed to line up. They've been so impressed with us and our ability to deliver that they are now allowing us to come into some more of their deal flow. But this is one of the better opportunities I've seen in 4 years, and that's why I personally invested. So if you are keen to get involved, I would highly recommend you just type in there Cyprus and/or investment consultant, because really it's it's an opportunity to get involved. And then the PPA group, if you understand how Wealth Migrate operates, there's 3 criteria that we look for. The company has to have a track record of more than 10 years. They have to have specific niche focus. So we don't want them doing everything. If RJ is doing houses and Paul's doing medical buildings, well, PPA group is doing multifamily. And we really like that. And the third one is that they have to invest their own cash. I think it's really important to understand that Monty, who's the owner of PPA, the 100% owner himself, has put in over $500,000 into this deal in the equity, not in carried fees, nothing, in hard US dollar cash, just like my US dollar cash and my business partners. A lot of us put our own cash in. Jacob, Michiel, Jay, Lyndon. Just to give you an example, a number of our wealth partners, etc. So our US dollars are sitting, right next to our investors there. And what I love about it is that Monty, put proper capital into it, which knows that he's going to look after that asset for us. They've got an excellent reputation. They manage over 4,000 units. They're a top 10 Texan company in the sector. They've been part of the Inc. 500 high growth companies for 2 years running. They've got 120 staff. And what I love most is that they're just an incredible team. I spent 3 days with Michiel at the offices. I can tell when a company is a good company with a good culture. And then what they do is real estate development, property leasing, property management, and property consulting. So very niche, exactly like we like, and with that reputation is why we're getting access to deals that you and I could never get access to, and that, to be frank, even the institutional investors haven't been able to get access to. And now we made it available to everyone because of technology from as little as $10,000. And then just in terms of our track record, I'm not going to go into this in too much detail. We can share this, but we've got quite a significant track record in America already in commercial buildings. And this is our medical portfolio that we started investing in 2014. It's producing a cash-on-cash return of north of 8%. And, there's been quite a large capital value play there worth millions of dollars, probably arguably north of $2.5 million, which over a $6 million equity investment is already a capital value uplift of north of 30%. Everything I mentioned is in US dollars. There's no rand devaluation. There's no funny games. It's specific numbers, specific track record that we can prove. Our Medical 2 deal, ironically, this one, the team did a really good job. I've invested in all these deals, by the way. Has a cash-on-cash return north of 10%. Some would say, wow, I wish I had invested in that. Well, don't say the same thing in 2 years when we're showing you the track record of Cyprus. This is Medical 3, a very beautiful building. You can see all the quadcopter videos if you're interested. They're all on our platform. Again, a return of, and again, I want to be very clear. These are cash-on-cash returns. They're not capital growth. They're not IRR. These are physical amounts of money that people are being paid on a quarterly basis. Medical 5. So that's actually just got to the end of the quarter, and my understanding is that the dividends have been paid this week. So I'm not sure if Makhil's online. You can give us an update as to the exact number there, but it'll be definitely on par. They've done a really good job. And then this was the deal I was mentioning in Brisbane as an example. This is a new development. Again, an IRR north of 18%, and again, a minimum investment of $10,000. You don't have to buy an apartment anymore. It's very hard to get financing if you're trying to invest in Australia. South Africa has been struck off the list of countries that they will lend to anymore. But if you want to go up the value chain and you want to invest in Australia, then you can do it with a very experienced developer. And as I said, Henny's built a company there that's now valued at north of 600 million Australian dollars. I think he's got a bit of experience and track record when it comes to development in Australia. And so just in terms of our pipeline, I'm not going to bore you, but Henny actually got back 2 days ago with Billy, and there's a number of deals in the pipeline, between different deals in Texas and in Georgia from a medical perspective. So, we've got multifamily, we've got medical, we've got residential development opportunities, and so the pipeline, continues, all the way through. And so if you are interested, the next step for me would be to go on the secure site, go to wealthmigrate.com. Log in. If you haven't logged in for the first time, do your KYC. I know it's a bit of a pain in the arse. It is for any of us in any investment we do, but once it's done. And then you can go and find the opportunity, be it Cyprus or Kensington, and or even the pipeline. I don't think the pipeline deals will be up. I mean, they literally got home 2 days ago. No, sorry, today's Wednesday. They got home last night at 5 p.m. So I can virtually guarantee you they're not up. I just wanted to give you a bit of a window into the future. And, you can really go and explore and get all the information, watch all the videos, see all the pictures, and read all the details. And, what I would also recommend if you want to talk to an investment consultant, one of the team, they're very, very, up to date on all the numbers. They can help you with your questions. And, ultimately you can follow the process and invest online. And, for me, I joke a little bit about Lemonade Day. The reason I mention that is it's a charity that we brought out to South Africa, and it helps children learn about entrepreneurship training. And I believe that if I can give that and self-belief to my son, then I don't really have to worry about university in 14 years' time, because, well, he'll be able to. I'm not even sure if university, the Oxfords and Harvards, will be relevant in 10 to 15 years' time. But the bottom line is it's a way to help children. So if you want to help your children learn about entrepreneurial training and getting self-belief, then that's a link to go to, because our whole thing at Wealth Migrate, again, is about giving you wealth preservation, giving you a plan B, giving you peace of mind, but most importantly, giving you freedom. And for us, wealth is much more than just money. Being a global citizen is much more than just money, and hopefully we can share a bit of value and help your children as well. And so I think that's all. I'm going to run through some questions. I didn't talk about the EB5, so let me talk a little bit about the EB5 while I just put up some surveys here. So we've got a very good partner. We looked into EB5 for the best part of 3 years. We traveled to numerous different partners on the ground. We've been to numerous different projects. From our experience, 98% of EB5s are a scam, virtually a scam in terms of the type of returns you can expect. And in simple terms, in EB5, you have to invest $500,000, and it needs to be in an area which is deemed to create jobs. So $500,000 needs to create 10 jobs. And if you comply with that and you deal with a partner that knows what they're doing, you can get a green card, which ultimately allows citizenship for you and your family. So not just you, but your whole family. And after scouring the market extensively, Henny and our partners, Michiel, finally came across a team of guys that are based out of Florida. And ironically, they've actually got a South African partner in the deal. So not an agent that just sells on the ground. It's actually South African capital that they started the Protea Hotels here in South Africa. They started investing in America 14 years ago. And they've got significant developments out of Florida, quite near to, it's in a place called Hollywood Circle. It's quite near to, I've just forgotten the name, the expensive place with all the boats. Anyway, it's about an hour and a half north of Miami. And this allows people to invest $500,000 and ultimately go through the EB5 and earn a good return. So if people are interested in EB5, type it in there and we can put you in contact. Our type of investments are more, if you want a Cyprus one, it's more cash flow focused. So if you want cash flow and you want to be paid on a quarterly basis, then Cyprus is the way to go. And like I said to you already, our core focus really is to create global citizens. And our belief is that if you've got first world assets or the first world income, you can actually live wherever you want to in terms of what it is that you're actually doing. So I think that hopefully answers some of the people's questions around the EB5. And again, if you type in the EB5, we can get a hold of you and or go on our platform. There's a chat function, or contact us by the old school way of the telephone. Let's look at the questions here. So I do have the poll up, but I want to answer some questions. Can you please explain exactly what you mean by internal rate of return? So Andrew, good question. It's the complicated way of looking at it is that there's 27 variables which are taken into account when it comes to return. So it takes into account inflation, capital growth, the return, the amount of capital you put down, the cost of financing, et cetera, et cetera, et cetera. I could give a course on an hour. But in simple terms, the internal rate of return is the best way to calculate the return, the total return on an investment, and it helps you to be able to compare an apple with an apple. So if you invest your money in property or bonds or stocks or anything else for that matter, then it's a way to compare the return of one investment to another. And it also takes into account the amount of capital you invest. So if you invest $100,000 in the stock market and you get a 10% return, you might not have taken into account gearing, and it also takes into account time value of money. So it is the most sophisticated way to analyze return, and it is what is used worldwide in terms of both property and or any other investment. So hopefully I've explained that in a simplistic enough way. Romaldo has asked me, does the rental go up annually in these areas as they do in South Africa? If they do, what percentage do they go up? So it's a good question. And the standard answer there, Romaldo, is in the first world they don't go up like they do in South Africa. Our inflation here, they tell us it's 6%. Based on cost of living, I would say it's much closer to 7, 8%, certainly in the sector we'll play in. And therefore rents tend to go up, 8 to 10%, although basically from experience of my residential portfolio, I haven't actually experienced that because of the oversupply and a lot of investors getting out of the market because of the draconian laws. But anyway, that's a completely separate conversation. So what you tend to find in first world markets where inflation's 1 or 2%, it doesn't go up dramatically. What we look for in an opportunity like this is where we can create a value add, a value play. And so by going in and doing small renovations, upgrading the carpet, the kitchen, putting in, new appliances, it really doesn't cost a lot of money. But by doing that, where you were commanding a rent of $750 a month, you can now command $800 or $820 or $850. And so that's the way we do it, and make sure that we get the rental increases like we spoke of. So Lee Rush put down there PPA. I'm not quite sure what that's about, but obviously just understanding the company, I presume. Gunter said, how do I move forward on investing in this, and ask more detailed questions? So Gunter, it's basically, I'll make sure that one of the investment consultants contacts you tomorrow, and we'll be able to take you through and answer any questions that you want. Given that the investor in this project can only be through the platform basis, can an LLC invest in the platform? I would prefer to still have my LLC involved. Thanks, Arthur. Good question, Arthur. I don't have all the answers. I suggest you chat with the investment consultants, and I don't know if Michiel's online. I know that he was with a client tonight and was going to hopefully join us a little bit later. I know that, again, it's not how we like to do stuff, but because of Fannie Mae, we can't afford to have a 1% cost on capital. It's $100,000 that's just been thrown away. And so we had to do it in this way. And I'm not sure if Michiel has a better way of doing that. So Daniel said, we're interested in the Cyprus investment. Great. Man said, I'm definitely keen. Let's test the platform. So that's awesome, Mandy. Yeah, please do use the platform. Our user experience went live. Our new user experience went live last week with our blockchain integration and listed into the regulated exchange. So it's all completely compliant, and we've had very good feedback on the user experience. So let us know. Andrew said, so Rion, you've asked us to contact you. Andrew said, please explain why you've moved away from your typical structure where Wealth Migrate invests alongside ordinary investors on a pari passu basis and structured this with a preference share for Wealth Migrate holdings only. Please can you also explain the finer details of the preference shares and how this impacts the risk profile of this deal for ordinary investors? So Andrew, I'm not 100% sure of what you're talking about. So in terms of the preference shares, I know that we had to structure the deal from a Fannie Mae perspective. There's two components to it. One is that we've obviously created the stable income fund now, so it allows us to be able to take down quality deals, because very good deals they're on the market for 30 days. And sometimes there's not the time to go to the market and allow investors like you and me to be able to get involved in the deal. So our stable income product allows us to be able to close on a deal, make sure we buy a quality asset at a quality price, and then allow investors to be able to get in, even if it takes a little bit longer than when the specific closing date was. If you know how America works, there's no ums and ahs, there's no delaying projects. You either close or you don't. Otherwise, you get sued, you lose your reputation, and you'll never get access to good deals. So from a preference perspective, my understanding is that there's no preference shares, and that it was purely a structuring thing from a Fannie Mae perspective. And I want to be very clear here. You know, our three core values are trust, transparency, and alignment, and all investors are treated the same way. If I've got anything wrong there, I will apologize, and I will make sure that I get that rectified, but I very much doubt it, because it would go against our ethos of how we do business. Okay, please clarify what the difference is in between syndication and crowdfunding. So good question, Teresa. So I think I've explained a fund to a REIT and the fact that there's 16 different middlemen between you and your investment. Syndication is an old school methodology that you know, the likes of ShareMax and Blue Zone have ruined in South Africa, and to be fair, it was ruined in America in the 80s. Because what they do is they take a huge fee up front. So ShareMax, as an example, took 26% on the front end. They weren't in line with the investors. They made all their money making a turn on the project, and they didn't actually care if you invested in a dump truck or a good asset. Whereas from our perspective, you know, we've created a listed, structured environment which allows people to invest in quality, you know, institutional grade assets, and there's a small fixed, completely transparent cost up front to do the due diligence, so that everyone, you know, at the end of the day, you want to make sure you're doing the right due diligence and that you're investing in the right projects. And then ultimately, Wealth Migrate makes a carry on the back end, and the partner, by the way, on the back end, so that all the interests are aligned with the investor. So, you know, many would argue that if you get in an Uber taxi, it still takes you from A to B. The car still has four wheels, it has a driver and an engine, and all technology is done is vastly improved the process. Hopefully, when I showed you the value chain, there's a significant difference between a fund, a REIT, and syndication in terms of what is happening in terms of, you know, like-minded investors coming together. I can see I've got a little monkey behind me who clearly hasn't gone to sleep yet. But anyway, okay, so the next question. So Rion's asked for to speak to the Australian guys, so that's perfect. You can see I'm just asking questions, which is interesting. Oh, Mandy's told me Fort Lauderdale. Thank you, Mandy. I remember as a kid when I was there in 1990, loving all the boats. Yes, my daddy's just finishing off. Okay.
In Mommy's room, I was staying up all night. I was staying up to wait for you with this light on.
Okay, I'm coming just now. Okay, I'm talking on a webinar. Okay, and sorry about that. I'm going traveling tomorrow and doing my webinar from home tonight. So at least you know we're authentic, and and we have families just like everyone else. And so anyway, so my point being is that yeah. So anyway, Mandy, Fort Lauderdale. So yes, it's about 40 minutes north of Fort Lauderdale. I've personally been on the ground. I've personally been to Hollywood Circle. Henny's just been there again. We feel very, very highly of the developer on the ground there. and so people are interested in EB5. Can state for the record, I did my EB5 through Hollywood Circle. So this is Arthur White. Arthur worked greatly, and I'm living in Dallas, Texas, with my green card in my pocket. Worked with Stuart and the SA guys. Oh, that's also awesome, Arthur. So that's fantastic. So well, there's a good example of someone that did the investment with them and is living in America. So it's certainly possible. Teresa, the rents go up after the units have been renovated. Twofold. So one is the rents go up after they've been renovated, but actually I met the lady's name. I could probably give you her business card because it's sitting right here next to me. Oh, how's that? So there's her business card. You can see there, Cypress Ridge. I've got her email, and her name was Anne Marie, and she was actually telling me, so this is what I love about the PPA group, is that the units were fairly badly managed, and so the PPA group bring in their significant experience, and she was telling me that the rents based on market around the area were actually down, and there was the opportunity to increase them. And so as people were renewing, she was gradually increasing them $20, $30, $40 per month, which doesn't sound a lot, but over 252 units, it makes a significant impact. That's without renovation. And again, you know, this is the type of thing we do. I get on the ground, I go ask the difficult questions. PPA group didn't even know that I was doing that and speaking to her. I wanted to make sure that our jockey on the ground could execute. Andrew said, did I miss the state of liquidity? In other words, can an investor seal out a position before the 5 years? So yes, the intended investment here is a 4-year investment. I think the thing that I like most, Andrew, is that now that we've basically digitized the whole process and joined together with the listed regulated exchange, we've actually created a secondary market. Now, at the moment, it's not a very active secondary market, but I mean, just today we helped an investor that invested in one of our commercial assets and wanted to get out. So at the moment, it's a bit of an off-market thing, but now with the secondary market, it'll become more and more liquid, which is fantastic, because the worst thing about direct property is liquidity, and now you'll have the best part about direct quality and solve the liquidity. Rowan has asked, are returns paid in SA bank accounts or in US bank accounts? So everything that happens for us is paid in the currency where the investment is made. So even if you don't have a US bank account, it'll be invested in your wallet, which is your online platform wallet, and it'll be in US dollars. So all the returns I've spoken about, everything's in US dollars. If you choose to bring that back in rands, that's your decision. We've also got a way legally for people that have used their overseas allowance, or don't want to use their overseas allowance now, to legally move money through an asset swap structure to be able to invest. The only thing is you would have to bring it back if you sold the asset. So it's just letting you know. So Billy just said he made his first investment. So fantastic, Billy. Oh, sorry, his second. So Teresa said, unfortunately, no LLC investments due to Fannie Mae. So yeah, I did talk about that. Daniel said, what is the risk by investing through the platform? So two things, Danielle. It's a great question. Firstly, something my wife asked. So if my wife's asking, and I'm sure the rest of you are, hopefully she trusts me if I'm married to her. She said, what happens if Wild Migrate go bankrupt? And I said, well, it's irrelevant. It's completely ring-fenced. It's owned completely separately to Wild Migrate. And therefore, if Wild Migrate was to disappear tomorrow morning, it wouldn't impact the investment one bit. The PPA group would be there. They would still be managing it. It would probably be a bit more of a pain because you would have to contact them directly. So that's the first thing. There's zero risk if Wild Migrate was to disappear. The second thing from a platform perspective is that the platform is purely enhancing and improving the process, making it a lot more efficient, reducing the cost dramatically. But at the end of the day, it's no different from you and I investing together, Danielle, and buying this asset. It still has lawyers. It still has closing. It still has full title on the property. And so, from a risk perspective, it's no different from investing in direct property yourself. It's just a way to enhance the process and also to make it more tax efficient. Then Sue said on Cyprus, so she's mentioned that I had spoken about the rental income increasing. So again, more than 50% of the units haven't been renovated. And so by renovating them, with a small capital outlay, it's not as significant. It's not a major renovation. It's more like a lick of paint and what we would call window dressing, and that allows us to increase the rental and ultimately increase the rent roll, which will allow us to be able to exit and be able to get the returns on the back end. And one of the reasons we like this investment is that it's very liquid. There's a lot of demand. Like I told you, over 20 different people put an offer on this particular asset. And again, we didn't pay the most money, and we still got access to the asset because of the PPA group. There's significant demand, and it's becoming more and more from the institutionals. And it's actually why a lot of people are starting to build apartment blocks. If you guys have met Bruce, one of our partners on the ground in Atlanta, they've got about 10,000 apartments that they own free and clear that they've been building. And their whole idea is that they stabilize the rent and then they sell it on to an institutional over a 3-year period. I think I've explained to you the whole value chain. We just want you to go up the value chain and not be able to, not let everyone else make the money. We actually want you to make some money. Okay, and then Michael said, all good investments. You can ask me. So Michael, has been investing with us. He came on a buyer's trip back in 2013, started investing. And what was very interesting was very clear on what his goals were. I can never remember why specifically, but it was $14,000 passive income. And I remember him telling me that he's got 2 daughters, and he had calculated that with $14,000 passive income, he could continue to live in Durban for the rest of his life, but that will ensure that his children were global citizens, his daughters. And, it's really gratifying that, 3 years down the line, he's well on his way to achieving that. So, I love hearing the stories of people. I mean, another good example was Ryan Boerter. He bought a number of houses off us, 7 houses in Australia back in 2009, 2010. He told me he wanted to move to Australia in 5 years. And, this year he moved to Australia. He sold some of the houses. He remortgaged some of them. He's living comfortably in Australia now, and he's bought his house on the Gold Coast. So a lot of these strategies we talk about, we've got real life examples of people that have actually done it, which I think is awesome. And so you can see there the questions. Anything else that anyone else wants to know? I've hopefully answered quite a few questions, and you can see the poll's open. I've got one last question that I want to ask on the poll that I'd be grateful, and it's all about learning. So how would you like to learn more? Would you like to be part of an investor breakfast? Would you like more webinars? Would you like to come on a buyer's trip? For me, the buyer's trip is the best thing. You get to spend a week with the likes of Henny and Dr. Dolph de Roos and myself and Michiel and Yaku and others, Jason and Yanni, and we've all been doing this a long time. You can imagine if I can share this much information in an hour and 20 minutes, what I can do in 7 days. And with all due respect, we obviously not everyone goes on every buyer's trip, so each one is different. But what's really important is that we also have a huge amount of fun, which is where people actually learn the most. So we're always interested as to what people like and where they're at. This is also just adding some value to you. So what do you want? Do you want the copy of the three white papers? So we've got the beginner for someone who's just wanting to get started. We've got the intermediate, someone who wants to become an international investor. And then we've got the sophisticated, someone who wants to create a global portfolio. And, a copy of the book, Property Going Global, I think is self-explanatory. Do you want to come to an investor breakfast? Dolph and I are talking about doing a 1-day course for offshore investing. We're tired of certain individuals coming here and massively overpricing courses and selling them to you, and then the call to action at the end is just to invest and pay more money. We don't make money out of selling courses. We make money out of helping people invest in quality assets. And we're tired of people being given rubbish. It's actually one of the reasons I wrote the book. So we're thinking of doing a 1-day investment course in February. So if you're interested, let us know about that. And or speak to an investment consultant who will be able to help you. So again, we're just looking at ways we can add value to you as an individual. And then lastly, I'm going to close that out. And the last one is that, how would you like to get involved? And it's just a couple of strategies that I think are important. The nice thing is now with $10,000 is that people can dip their toes and get started and see whether, it's all rubbish. If you don't trust us, I completely understand. Most people don't. I always laugh at Michael, who's online now. He didn't trust us 3 years ago. I wouldn't trust people. There's too many scams out there. There's too much, sounds too good to be true. Yet we've got the track record. We've got thousands of investors with testimonials that you can talk to, and we can prove it to you. But even if you don't trust us, come on a buyer's trip, and or invest a smaller amount of money. And, to answer, I think, Rion's question earlier, I love to invest in income-producing assets and growth assets across England, Australia, America. And, I don't believe it's about putting, $10 million into one deal. if I can diversify my personal family's portfolio across countries, across different assets, I think it's awesome. So watching and working in a circle. So our inner circle is like our inside club that get access to all our information, the due diligence, and it's our whole philosophy there is learn by doing. So we again, we don't have a coaching course, we don't have a mentoring course, but we do it by learn by doing. And if you go on YouTube and Google Inner Circle, you'll see a whole lot of videos Dolph and I did as to how that actually works. Again, the full day course I've spoken about, come on a buyer's trip, that's one of my favorite things. I think it really differentiates us from everyone else. So many people say to me on the buyer's trip, they say, Scott, but how can you do this? How can you just have complete transparency? I mean, people are absolutely overwhelmed from South Africa, China, everywhere, that they literally sit in meetings with any while he's negotiating a deal. And we're like, well, we've got nothing to hide. We've got complete transparency. If we buy it for $1 million, you're going to buy, you're going to invest in it at $1 million. It's not like ShareMax where we're buying it for $1 million and trying to sell it to you for $5. And the beauty is when you've got nothing to hide and you believe in partnership and the whole abundance mentality, then we can do buyer's trips and we can show people everything we do on the ground. And lastly, if you want to become a wealth partner, it's something that we set up 2 years ago. It's by invite only, but a lot of people want to be able to invest in the deals, and they're quite excited with where Wealth Migrate's going. I'm very grateful and humbled. Last night, the KPMG FinTech top 100 companies came out. We're actually in the top 50. And, there's companies there that are worth more than $10 billion. And, little Wealth Migrate is in there in the top 50, which is phenomenal. And, we've had, we're very humbled to have wealth partners that have been part of that journey and are enjoying not only investing in first world, quality assets, but have also invested in a US dollar-based company or platform that has every opportunity of being the next, Uber or Airbnb in the space. Well, certainly I'm going to continue trying. I'm going to die trying. So if people are interested from the wealth partner perspective, let us know. But as I said, it's only for specific individuals. There's got to be a value add, and it's by invite only, because we only want to deal with like-minded people that want to build a great company, go out there and solve the greatest challenge on the planet. So hopefully that gives people a little bit of understanding. So I'm going to close out that poll, and I'm going to go back to the page here with the contact details. Lee said, if we invest in Cyprus, we are not leveraging our money as much as a single mortgage home. No, Lee, you no disrespect, but you're very wrong. It's actually far better. If you buy a house right now in America, you will at best get a 50% loan to value, and the cost of capital will be closer to 9.5%. We've really struggled, particularly for foreign investors. If you invest in Australia, basically you can't get a mortgage in Australia if you're a South African resident earning a South African income. If you're in the UK, you can get a 50% loan to value. Whereas here, because we're working with partners and because they've got an extensive track record, our cost of capital is 4% and our loan to value is 70%. So although this is a $15.7 million deal, we're only investing $5.7 million in equity, and we've got $10 million in leverage from the bank. So you very much are participating in a leverage opportunity. But the best part is that you're leveraging off partnerships. So we would not be able to, neither Wealth Migrate nor anyone on this webinar would be able to get those type of terms for financing. But because we partnered with the likes of the PPA group, we've been able to organize that. Man said, thanks, Scott. Sounds very exciting. I want to help the ladies, even here in Switzerland, invest. So let's go for it. Awesome, Mans. Yeah, I know what's happening in Europe. I know the type of returns there. I also know the volatility, and I think you've known me long enough. Mandy and I have known each other for over 10 years. It's all about finding quality assets, finding safe income-producing assets that can help us through the up-and-coming future from an economic perspective. Whether Trump is president or Hillary's president, I think it's fairly irrelevant, but we've got some very tumultuous economic times from a global perspective, and that's why the biggest lesson I learned from Henny Besaidnout and Peter Feenstra, who are both billionaires during the last global crash, they weren't investing in assets which were based on capital growth. They were investing in stable income-producing assets because it helps them ride any economic climate. And those same people are the ones now that not only have I learned from, but we are partnering with and helping others be able to make those same sort of wise, smart decisions. So thank you, Lee. I'm glad we answered your question. Little man, come sit on my lap here. I think we're nearly done, boy. I can't see any more questions coming through. So yeah, if there are no more questions, then I need to put this little man to bed. It's quite late. Not quite sure. His mother's obviously having to put him down when he can hear his daddy talking. Do you want to say anything to anyone? Bye. Do you want to give him a wave? Okay. Good night, everyone. Jenny, thank you very much for all your help. Thank you for everyone being online. I know we've been online for quite a long time. Hopefully we shared a lot of value. And the last thing I would say is that we're always looking to improve. So if you want to, you've got an email in terms of both signing up for this and the follow-up and or go on the platform. Let us know what you want to know about. How can we add value to you from a webinar perspective? Who else would you like me to interview from a webinar perspective? Would you like me to interview Henny? He's just been to exponential medicine, and you understand the trends of what's happening with medicine around the world. Would you like Henny to give some insights into some of the deal flow? We've secured over $3 billion worth of institutional grade assets out of America and Australia, and would you like to hear from him as to why those markets and who the partners are? Who else would you like to hear from? Clem Santa? Who else would you like to hear from? We want to be able to add value. So let us know, please. We're always looking to improve and increase. And then Daniel said, is there a video about the development that you will watch? Yes, there is, Daniel. I personally went there and filmed it with my quadcopter. So you can see it from every angle, whether you want to go horizontal, vertical, the area, the proximity to Houston, downtown, everything is there. And Andrew said yes for Henny. I'm not surprised the wealth partners are interested in that. So I was talking to the team today, and I'm meeting with Henny tomorrow in terms of, I don't know when we'll be able to do that, but hopefully something we can do. And cool, we've got a couple of comments coming through, so I'll stay online for another 30 seconds or so, but I don't see any more questions, so I think we'll call it a night tonight. Thank you, everyone. As always, go out there, take action. Whether you like us or not, I don't care, but please make sure that you take decisions today that allow you to have the freedom like my uncle did in the future, because that's all that we're passionate about, is providing you with that freedom. Thank you for your time tonight. I appreciate it, and chat to you soon. Bye then. Oh, and Louis said he wants a Wild Migrate weekend. We need to do one of those, Louis. It's been a while. Although we've been to Durban a few times, and you guys haven't turned up. I don't know if it's, we're not wearing deodorant or something. You don't like us anymore. But no, I'm joking. Down in Durban next week for those that are in Durban, and Cape Town the week after, Johannesburg tomorrow. So between us and our team, we're getting around before the end of the year. Cheers, everyone. Have a good evening. Good night.